G'day and welcome to this week's client question. This week we've been getting a few calls, or at least over the last few months, generally around how do I reduce my taxable income. And the people I'm thinking about here are self-employed farmers for the most part, but some of this information can be relevant to the everyday worker as well. But it will have a slant towards the farming community and small business owners. The one that is a general one where people can save tax very easily is utilising the superannuation concessional contribution of $25,000 per year. As I've always said, that is the gimme, that is the low-hanging fruit, the easy win that you need to get each year, and you'll pay only 15 cents on the dollar on the money you put in for a concessional contribution or salary sacrifice, compared to your marginal tax rate, which can be as high as 47%. So utilising your superannuation is really, really important. Now, for younger farmers, or farmers in general, you can use what they call farm management deposits, and that is where you can put money away, lock it away for at least a year before you can access it, but that money will not be counted as a tax deduction in that financial year. But at some point in the future, you've got to bring it out, and that's when it will be taxable. So essentially, all you're doing is kicking the can down the road. But for farmers where you have some very big years and then you have a drought year, it makes sense to use farm management deposits. So instead of having a substantial amount of income in one year and being taxed extremely hard, you can defer it, kick the can down the road and bring it out in a year where it's been a bit tougher. So one thing that I often recommend clients that are getting closer to retirement, 55 and above, that you should start using your superannuation concessional contributions to the max before you use an FMD. So that's what we'd recommend a lot of clients do. Younger farmers, FMDs become even more important because putting money into super locks it away for at least till they're 60. So FMDs can play a really important part. Buying stuff, obviously, to help create tax deductions, so upgrading tractors and headers is something that I see a lot of, and often that advice can come from other professionals. But I would recommend that people should only buy equipment, utes, tractors, the stuff they actually need. Don't buy stuff you don't need. Don't buy stuff that is just a slight upgrade in what you've got. Will not help efficiency, will not improve the bottom line. Please do not chase tax deductions on assets that will depreciate over time. It's essentially like spending $1 to save 30 cents. I prefer to pay tax of 30 cents and invest $1 in assets that will grow over time. Then, of course, there's the $30,000 instant tax write-off option, and that's through to June 2020. So that's where you can go and make a purchase of anything up to $30,000, and that will be an instant tax write-off. But again, as I said before, don't do it because you've got a tax problem. There's other ways you can do it first. Super contributions. And remember, every dollar you spend as a tax deduction is only saving what your marginal tax rate is. So don't go and find deductions just for the fun of it. You spend $1, the government is not going to give you $1.50. You spend $1 on a deductible item, you're only going to save your marginal tax rate, 21%, 34%. So you'll never get more than $1 back. So that's today's client question. Thanks very much for listening. Please subscribe to the channel if you haven't already done so, and those that have, thanks very much, and remember to hit the little bell icon to get a notification. Thanks for listening, and we'll catch you next week.